For thousands of years, gold was untouchable. It crowned kings, backed empires, and defined wealth itself. Nations rose and fell by the amount of it they could dig from the earth or store in their vaults. It was money, pure, incorruptible, eternal. But then one day, it wasn't. On a quiet Sunday in August 1971, the President of the United States looked into the camera and spoke 38 words that ended a 5,000-year legacy. Overnight, the world's most stable store of value, gold, lost its crown. What followed was chaos, inflation, debt explosions, and the birth of a financial system that runs not on gold, but on trust. This is the story of how gold was dethroned, how money became a promise instead of a metal, and how that one decision still shapes every paycheck, every price tag, and every crisis we face today. Why gold ruled the world. Before we understand how gold fell, we need to understand why it ruled for so long. Since ancient times, from the pharaohs of Egypt to the traders of the Silk Road, gold wasn't just shiny metal. It was mathematical perfection. It was scarce, durable, divisible, and universally desired. No government had to tell people gold was valuable. It simply was. When money evolved from barter to coins, gold became the ultimate form of trust. A coin with a ruler's face wasn't valuable because of the ruler. It was valuable because of the gold inside it. Empires like Rome, Byzantium, and Britain all built their power on it. And when modern finance emerged in the 19th century, gold was formalized into something called the gold standard, a system that anchored the entire world's economy to one precious element. The gold standard in the Age of Discipline by the late 1800s. Nearly every major nation had tied its currency to gold. What did that mean? It meant that every paper note in your hand, every dollar, pound, franc, or mark could be exchanged for a fixed amount of gold. Governments couldn't just print money. They had to own enough gold to back it. This system was strict, painfully so, but it worked. It kept inflation low, balanced global trade, and forced countries to live within their means. During this age of discipline, currencies were stable and long-term savings actually grew in value. Economists later called it the golden age of money, but stability came at a cost. When war came, the costliest activity known to man, gold became a prison. The wars that bankrupted empires. When World War I erupted in 1914, nations realized they couldn't afford to fight while tied to gold. Wars demand spending, weapons, soldiers, supplies, and gold couldn't be printed. So one by one, governments suspended the gold standard. They printed paper money to pay for war. Prices soared. Savings evaporated. After the war, the world tried to return to gold. But the damage was done. The British pound collapsed. Germany spiraled into hyperinflation. By the time World War II ended, the global financial system was in ruins. Everyone agreed something new had to replace it. And in 1944, in a quiet resort in New Hampshire, the leaders of 44 nations gathered to decide what money itself would mean in the new world. Gold's last throne, the meeting at Bretton Woods, was historic. The world needed stability, and gold was still seen as the ultimate anchor. But the U.S. had emerged from World War II as the undisputed economic superpower. It held 2/3 of the world's gold reserves. So the deal was simple. Every country would peg its currency to the U.S. dollar. The U.S. dollar, in turn, would be pegged to gold at $35 an ounce. This created the Bretton Woods system and effectively made the U.S. dollar the world's reserve currency. For a while, it worked beautifully. The post-war boom filled factories, built suburbs, and fueled the American dream. Dollars flowed across the world, and everyone trusted them because they were as good as gold. But then, trust began to fade. Nixon, de Gaulle, and the dollar's dilemma. By the 1960s, the cracks in Bretton Woods began to widen. America was spending wildly on the Vietnam War, on the space race, and on President Johnson's Great Society programs. Yet gold reserves weren't growing nearly as fast. Foreign nations, especially France under President Charles de Gaulle, saw the imbalance. De Gaulle famously declared that he didn't trust paper promises and began demanding gold in exchange for his country's dollars. Shipments of U.S. gold started flowing out by the ton. The once mighty Fort Knox began to empty. Meanwhile, American citizens were banned from owning gold. They had to trust paper dollars that were supposedly backed by something they could never touch. The illusion was cracking. And in 1971, the numbers no longer added up. There were far more dollars in circulation than gold in the vault. Something had to give. August 15, 1971. The day gold lost its crown, it was a Sunday evening. The markets were closed. Most Americans were relaxing at home when President Richard Nixon appeared on national television. He announced what would later be called the Nixon shock. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold. That single sentence, suspend temporarily, ended the gold standard forever. Overnight, the dollar was no longer tied to gold. It became what economists call fiat money, money backed not by metal but by government decree. At first, Nixon assured everyone it was only temporary. But like most temporary government policies, it became permanent. The world woke up to a new reality. Gold no longer ruled. The dollar did. Chaos, inflation, and the petrodollar, the immediate aftermath was chaos. Currencies around the world began to float freely for the first time in history. Exchange rates whiplashed. Inflation exploded. In the US, prices doubled within a decade. The oil shocks of 1973 and 1979 made things worse. Suddenly, the cost of living soared, and people realized that their money bought less and less every year. But the US government had a plan, a new kind of power play. In 1974, Washington struck a deal with Saudi Arabia. The Saudis would sell their oil only in US dollars, and in return, America would protect them militarily. This created what became known as the petrodollar system. Now, every country that needed oil, which was every country, had to hold US dollars to buy it. Demand for the dollar skyrocketed, even without gold backing it. The US had replaced gold with something far more strategic: global dependence. From discipline to debt, with gold gone, governments were free from the discipline of scarcity. They could print money at will, and they did. Debt, once constrained by gold reserves, began to explode. In 1971, U.S. national debt was about $400 billion. Today it's over $34 trillion. Inflation became a permanent feature of the modern world. Prices always rose. Currencies always lost value. People began treating debt as wealth. Central banks learned to manipulate interest rates to control inflation. The new economy wasn't built on production, it was built on credit. And while the rich used debt to grow richer, the average worker found that saving money was no longer enough. Gold had enforced honesty. Fiat money allowed illusion. Faith in central banks. Once gold was gone, money itself became a matter of belief. Central banks became the new priests, promising stability, managing inflation and stimulating growth, but their tools were abstract. Interest rates, quantitative easing, bond buying, words that few truly understand, yet that affect every paycheck and mortgage on Earth. Whenever a crisis struck, the dot-com bubble, the 2008 crash, the pandemic, the solution was always the same: print more money. Each crisis required bigger rescues, lower rates, and deeper debt. The system became addicted to its own medicine. And yet, through it all, gold quietly remained, not as king, but as a silent witness. The digital gold rush fast forward to today. Inflation has returned. Currencies are weakening. Nations are once again questioning the dollar's dominance. China, Russia, and others are hoarding gold again, buying at record rates. Meanwhile, ordinary people are turning to something new: Bitcoin. They call it digital gold, a modern rebellion against central control. Like gold, it's scarce, decentralized, and immune to manipulation. But unlike gold, it exists only in code, a perfect symbol for a world that traded metal for math, scarcity for software. And yet, even Bitcoin depends on one thing: trust. Trust in algorithms, trust in adoption, trust that someone else will value it tomorrow, just like we once trusted paper, just like we once trusted gold. When money becomes faith, every empire in history eventually abuses its currency. The Romans diluted their silver coins until they were worthless. The French issued paper assignats until they triggered revolution. The British debased the pound after 2 world wars. And now, the United States prints trillions in digital dollars to postpone a reckoning that never truly ends. When Nixon closed the gold window, he didn't solve the problem. He simply delayed it. The debt, the inflation, the inequality, they are not anomalies. They are symptoms of a system that lost its anchor half a century ago. Gold's revenge, ironically, as central banks print more money, they are also buying more gold than at any point in modern history. In 2023, global central banks purchased over 1,000 tons of gold, the highest amount in more than 50 years. Why? Because even the creators of paper money know its limits. They understand what the public has forgotten. Gold doesn't default. It doesn't go bankrupt, and it doesn't need a promise to be valuable. In times of crisis, gold becomes relevant again, not as an investment, but as insurance against human error. Perhaps the crown was never really lost, just stored away, waiting. What the fall of gold teaches us, so what can we learn from the day gold lost its crown? 1. Every financial system is built on trust, until it isn't. When Nixon ended gold convertibility, the world entered an age of belief. As long as people believe money has value, it does. When that belief cracks, everything burns, from savings to nations. 2. Discipline disappears when scarcity ends. Gold forced governments to live within limits. Fiat money removed those limits. The result is a global economy drowning in debt, sustained by printing and promises. 3. What ends with gold begins again in crisis. Every few decades, the cycle repeats. Debt piles up, currencies weaken, and people look for something real again, something that can't be created with a keystroke. The next crown, as we move deeper into the 21st century, new forces are challenging the dollar's rule, from BRICS nations creating gold-backed trade systems to digital currencies controlled by governments themselves. Will the next crown belong to gold again? Or will it be worn by something entirely new? A digital empire of money that never sleeps, never runs out, and never forgives? The next crown history whispers that every time humanity replaces reality with promises, the reckoning is only postponed, never prevented. The day gold lost its crown wasn't just the end of an era. It was the beginning of a long experiment in faith, paper, and power, and that experiment is still running. If this story made you question what money really is, hit that like button, because that's how we reach more curious minds like yours. Subscribe for more deep dives into the hidden history of finance, where every crisis has a cause, and every dollar has a story.